All right. How's everybody this morning?
Great.
I'm pretty excited. I made it to the office. Only had one little issue. My pant leg got caught in the chain spoke as I was taking off at
Oops.
left. That was kind of, I was like, wow, one of those things. But anyway, all right. Today we're going to talk about finance contingencies. And I know everybody's excited to talk about finance contingencies because they're super important. So let's talk about first step into finance contingencies. And I'm going to make you guys smaller because you'll block most of the screen. Why do we need a finance contingency? Well, if you're worried the buyer's financing won't be approved because of them, you probably want a finance contingency, right? If you're worried the buyer's financing won't be approved because of the property, you probably need a finance contingency. Now, I say it like that because it could be an appraisal issue, but it could also be a building compliance issue, right? Anybody that's sold condos could, those are the easy ones. The easy example is a condo that doesn't meet the questionnaire properly or doesn't, whatever, is not the right type of building. Let's say you're trying to do an FHA, it's not an FHA approved building and you want to do spot. Like there's so many different examples with condos, but believe it or not, there are single family house compliance issues too. We've had houses where the sewer line looked like it was going underneath the corner of the house. And we had to prove that it was more than 10 feet away from the house in order to get the lender to agree to do the financing because they don't want to buy a house that the public sewer, not just the home sewer, but the public sewer line is going underneath the house because what happens when they have to fix it? They dig up that part of the house, right? So that's not good. What other reasons would you need a finance contingency? This is the interactive part of the conversation. So tell me, what do you think there are any other reasons why you would want to do a finance contingency?
Yeah, they need to sell their house.
Okay, so a little bit of a different contingency than a finance contingency. I guess you could, there's kind of a sideways way to use a finance contingency for that, but technically you should use the sale or lease of the buyer's property contingency for that. Technically, I mean, you can use the finance one if you do it in a certain way. But anyway, what else? But keep that in mind as we go through the finance contingency because we'll talk about that. Any other reason that you would want to use a finance contingency?
To give you time to have the home inspected?
Home inspected during due diligence, finance contingency doesn't matter. So
Right.
you're good with that.
Have the cash.
Person's career is slightly volatile.
Career slightly volatile. Yes, that's a good one. I think that falls under the number one of potentially not being approved because of them. Yes, for sure. Dan mentioned not having the cash. Does a finance contingency help you if you don't have the cash? Well, keep that in mind. We'll getting ready to look at the cash contingency, and we'll determine if that actually works or not. Part of my point here is that so the one thing that has come up in our conversations, and we've talked about at one of our sales meetings recently, is the comfort level of the listing agent. Have you ever represented a buyer and submitted a contract without a finance contingency because you didn't need one? And the listing agent kind of lost it a little bit and was like, you're missing, your contract's not complete. Because I can't tell you how many times I've heard that. I mean, in reality, your contract is complete, as we discussed in going through the contract. It's an all-cash contract that you're planning to bring money to the table at closing for, and it doesn't really matter where you get the money from, according to the contract, right? If you want to go dig up a chest in your backyard that has cash stacked in it, as long as it's legal tender and you can get the closing attorney to take it, in that case, you probably have to run it through a bank first, but it doesn't really matter, right? Like if you've got gold doubloons that you're going to cash out and that's what you're going to use to buy the house with, the contract doesn't care, but the listing agent might. And so for me, that's the one thing you have to figure out when you're in conversation with the listing agent is if I present them with a contract that has no finance contingency, even though my client's doing a loan, are they going to freak out? And if they're going to freak out, well, then I would probably put a contingency in there. I would make it silly and I would make it the same as the due diligence, and we can talk about that later. But you don't want to cause any issues, especially in a market where we've got competitive buyer situations, right? Like where as a buyer, you're hoping to get the property. You want to do everything you can to make the seller and the listing agent happy, right? So that would be the only other reason that I would think you'd validly try to use a finance contingency. Although, in my opinion, and it is my opinion, that's silly because not having contingency is better than having one. Like it gives you another out. I don't know why a listing agent would want that for their seller. If you talk about the balance of risk of contracts, and have a conversation with Seth Wiseman, he will tell you that it is a balance game of how much risk falls on the seller, how much risk falls on the buyer, and putting in a finance contingency when you don't need one puts more risk on the seller than it does on the buyer. And so that's it, because it alleviates some of the risk for the buyer, which is kind of silly for a listing agent representing the seller to want, but it does happen. All right, so let's get into the
Brett, can I ask a question though?
Sure.
If you do not use the financing contingency exhibit, you also lose the ability for the 8-day extension if there's an issue with the lender side, correct?
No, that's not correct.
Not correct? Okay.
Nope. Remember when we went through that section of the contract? That's
I might
in
not
the
have been there that
contract
day.
itself. Yeah, you might have missed that one. Go back,
Yeah.
watch it on YouTube.
Okay.
That part is in the contract itself,
Okay.
and it does not require a contingency to use the 8-day unilateral. In fact, what we're going to
Okay.
find out is some of the contingencies actually take away your right for an 8-day unilateral.
Okay.
So we'll look at that.
Okay.
But good question. Yes, because you do want to make sure you're not losing something by giving it, right? So let's pretend we have a cash buyer that, can you guys see the top of the screen? Because mine is cut off a little bit with this weird little Sherry screen thing. Let me try to move that somewhere else. There we go. All right, so this is the no financing contingency, also known as the all cash exhibit. Also known as the only appraisal I'm not getting a loan or I might be exhibit. And so this first section is the section that you would mark if it's an all cash purchase or it's a finance purchase with no financing contingency. So let's look at the all cash purchase. To Dan's point earlier, if I submit this contingency says that buyer has sufficient liquid assets to purchase the property in this transaction for all cash. In other words, I don't have stacks of gold doubloons that I have to sell and liquidate. I don't have investments that I need to liquidate.
Crypto.
I have liquid assets, which crypto technically is. It's considered a form of cash. So that would be what I would go forward with. The buyer has no right to unilaterally extend the closing for 8 days for reason of mortgage lender delay. Notwithstanding the above, the buyer shall have the right to extend the closing for 8 days if the closing attorney is not ready, except if the basis for the closing attorney not being ready is due to or related to the mortgage lender delay.
Okay.
So Robin, to your point, if you choose option A, you may not extend this closing if the lender has an issue. You can extend it if the attorney has a title search or a whatever issue, but not because of the lender if you mark A. That's important to know, because if you don't do this contingency, the contract is an all cash purchase and you still have the right to extend the contract 8 days. So that's an important distinction. Now you might do this no finance contingency with no finance contingency, right? And you're telling them up front that you're going to finance it. So the buyer intends to obtain mortgage financing to pay for all or portion of the sales price. However, the agreement is not subject to a finance contingency. Even though the buyer is obtaining a mortgage loan, the buyer has no right to unilaterally extend the 8-day closing. So there we are again. This contingency negates, no matter which section you pick, negates your ability to extend for 8 days due to a lender issue. So if you are maybe, like, how many times you've had a client that was gonna pay cash but might get financing if it works out the way they want it to? Now all of a sudden they're doing financing, they have the cash, so they could buy it, but they'd rather not put all their cash into it. They'd rather put 20% or 30% or whatever into it, and their lender gets a little bit of a delay at the last minute. Now you're screwed if you've used this contingency. So that's very important to know the fine print there. Another fun piece, if I can click on the right screen here, is this next one. If I've marked option 2, I mean option B on the first page, I'll remind you, option B is the finance purchase with no finance contingency, which tells them I don't have all the money, but here are the verification of funds. So this is the required information. And obviously C says if option 1B was selected, a loan commitment letter from a mortgage lender is sufficient, which is good because they're paying attention. But again, if I picked 1A, where I'm paying cash, I don't need to provide either of these things unless they ask for them. If I'm using just the normal contract, right?
Right.
Something to consider. Now, is it horrible to provide proof of funds? I mean, theoretically, if you're making a strong offer in a multiple offer situation, you're going to pay all cash. You probably include the mortgage or the proof of funds as a part of the offer, right?
Make it look
Good
for the listing
practice.
agent.
So if you're making it look good for the listing agent and the seller, and you've provided the verification of funds, this paragraph doesn't mean anything because you've already provided it, right? Authorization and security. This gives the buyer, gives the seller and the seller's broker the right to communicate with any person providing information regarding the source of funds. So if you've got a private banker, if you've got a bank, if you've got a mortgage lender, they can talk to those people. Then it gives the seller the right to terminate. Do you know how rarely that comment is made in our contract? The seller has the right to terminate if the buyer fails to provide the required information, timeframe set above. They can give the buyer notice of default, and the buyer has 3 days to fix it. And then the buyer, if they don't cure it, the buyer may terminate within 7 days thereafter. If they don't, they've waived that right to terminate, which is very common. If you don't exercise your right to terminate, you lose it. So important to remember. But I mean, you would think that if you give them 3 days to fix it, they're probably going to. But if they don't, then you at least have the right to kill it. Then comes at the bottom there, the appraisal contingency, which is probably the main reason why most people would use this exhibit. It says that it shall or shall not. Now, this is the fun part that I love. Somebody submits this exhibit with 1A checked, meaning it's an all cash purchase, and it's not subject to an appraisal contingency. Talk about a waste of paper, right? Like there's just no need to have that. Literally, you're just saying what the contract says.
Well, and you're subjecting yourself to other issues.
And you are subjecting yourself to other things that if you don't provide the verification, the seller could terminate. So, there are just lots of things that I don't see why people do the way they do, but they do. Type of appraisal, obviously, it's a certified appraisal. And then the selection of the appraisal, of course, in this situation is important because if there's not a lender, which you could just mark or other and put lender in that box, right? Because in this case, if I know I'm going to have a lender, the lender's the one that's going to do it. Then you have your appraisal. Questions?
Does that say how long you have to get the appraisal?
It doesn't in this section, it does in the next one. Let me
Okay.
try and get this thing to get out of the way a little bit. It's just not going to do it. It's not cooperating today.
Doesn't go to the side.
It doesn't go to the side. And they probably can't see it. You guys can't see my little floaty bar on yours, can you? It blocks part of our screen.
A lot of it went away.
All right. So this section is the section that says if it does not appraise, then you have the X number of days to request a reduction in sales price. And then, of course, the next paragraph says that you're not obligated to seek a price reduction because you don't have to. And this is a similar paragraph to all the others as far as submitting the ATSP and it not being less than the appraised value and the time of the closing and the seller not accepting it and the buyer having the right to terminate but not obligation in 3 days and blah, blah, all this stuff that you should read because you need to know when can I terminate and the last date, you know, and how that goes. Does that make sense? And you can't, this is my favorite part of the sentence. In neither circumstance shall the buyer's right to terminate extend beyond the time of closing.
Oh,
So you can't find out the day before and all of a sudden wait till 2 days after it was supposed to close to terminate. Like that would be obnoxious. So talk to me about your options on why you might choose to use this, but is there another option if you didn't want to submit yourself to all of this stuff, losing the 8-day unilateral, the verification of funds, the seller's right to terminate? If really your only concern was the second concern that the property is not going to appraise, what could you do instead of this?
Do the appraisal during the due diligence.
You can do the appraisal during the due diligence, which is a fabulous suggestion, because if you can get the appraisal done during the due diligence, well, you can negotiate anything during the due diligence, right? So if the appraisal comes in and you get it's low, then you negotiate that and you're safe because your earnest money is protected during due diligence. What's another option? What if your due diligence is forced to be super short because of competitive situations and you've got like a 3-day due diligence? You're not getting an appraisal done in 3 days these days, I don't think, at least through a lender in particular. And so what happens if you need longer than due diligence? How else could you approach this?
there's not an appraisal contingency separate form, is there?
There's not.
Okay.
Interestingly enough, there's not.
So could you use some of that language in a special stip?
You absolutely could write a special step, and that was going to be my hint. It was our topic from last week, is special steps. You could absolutely special step this. And I would basically copy and paste 5, all of it, A, B, C, and D, right? And just put it in a special step. Why not? What's that hurt? What it does is it gives you what the appraisal contingency is without all of the other baggage that comes with this particular exhibit.
Just says you want an appraisal
Right.
contingency.
All it does is make the contract contingent on appraisal. Okay,
Can I ask you a quick question?
sure.
Yeah, so is there a special step that's already available to us? I know that
We went through
compliance
all of
quote-
them. I don't remember seeing one that said appraisal. There used to be years ago, but I don't think there's one in the system.
I mean, do you really want us cutting and pasting and creating our own special stipulations? I know that that's not creating the same new language, but that's definitely
I would
you know,
much
you-
rather I would much rather you copy and paste language out of an exhibit that exists than create your own from scratch.
But aren't we, look, if we miss a sentence or the wrong letter, so
sure.
we created our own special step, and I mean,
You have.
you're comfortable with that?
Well, I mean, I think you all are professionals and you can do that sort of thing. I mean, technically we are allowed to write steps, as we discussed last time. But yes, whenever you're doing something, just as when you're filling in blanks or checking boxes or whatever, your due diligence and making sure that you haven't missed something or it doesn't say something different than what you think it's supposed to say, is important. So to that point, yes, if you're copying and pasting this into, you should make sure that it says what it's supposed to say and what you think it's supposed to say, as opposed to what it says because you typoed something.
Okay, so if we basically cut and paste the whole thing, we could just eliminate the checkbox that doesn't pertain.
Yeah. Now, typically when you create a stip out of language like this, so like this agreement shall or shall not,
Just say
you would
check.
just get rid of the little check boxes and leave the word shall and get rid of the shall not.
That's right.
And you know, the same thing down in the selection of the appraiser, you'd get rid of the whole thing about, you know, you just say selected by the lender or the buyer or whatever, and all our parties agree that the appraiser shall only perform a single certified appraisal of the property kind of thing. And then same thing here, you know, number of days. So yeah. Good questions. Any other questions about the cash, or also known as no financing contingency? No? All right. Let's move on to the conventional one. Conventional loan contingency exhibit. This is why do we use this?
It defines what loan is being requested or.
Because we're worried that the buyer is not going to match up for the lender, right? That there's going to be some potential issue with the buyer qualifying, and therefore, you know, being that sort of thing.
Or put
So
a limit on some of the.
yeah, it limits that risk. And it clarifies to the seller what kind of loan we're talking about, right? And in this case, we're doing a conventional loan. We're going to talk about first and second mortgage. Anybody seen a second mortgage part filled out in the last decade? I mean,
Less than a decade, but a while.
it's been a long time. I bet if you really thought about it, it's been longer than a decade. Time goes faster than you think, my friend.
Probably.
But so from that perspective, you know, just oftentimes, you know, you only have to fix one of the boxes. You don't have to do all of them. You want to put in the percentage, the loan amount, the loan to value, right? Percent of the purchase value, percent of the purchase price, the term, how many years, the not greater than percent per annum. All right, so let's talk about this because this is the first time we have approached this. I have a buyer, they're approved for a loan for 6%. Okay, I know, using that number a year ago, people would have been like, oh my God, that's so high. That's actually a decent rate these days. So a 6% loan, what do I put in there? If I have a pre-approval letter that says 6%, what do I put in this box? Jacqueline? I know I'm calling people out now. She's still there? Come on now.
Yes, I'm still here.
Okay, dude, what do I put if my pre-approval letter says 6%?
94,
No, on my interest rate.
the second part.
There.
Yeah. Isn't that what you put?
Nope. So you're going to put the interest rate that you think that your client's going to get. So in this case, they have a letter that says 6%. As the buyer's agent, this is the conversation that I want to have. I'm drifting us in the wrong direction, but let's try again. As the buyer's agent, do you want that percentage to be lower or higher than where you think the loan is going to actually end up?
I send an
I
email
always
to
do.
the buyers and ask the lender what I should put in there.
Okay, that's a good one. Dan says he asked the lender. Derek, what were you saying?
I always put it higher than what I think the rate is going to be.
Okay, as representing the buyer.
Yes.
Okay, why?
Just in case something switches around a little bit and it ends up needing to be higher than what the letter says, then we can have that little bit of wiggle room because I think it says not greater than
It does.
6%.
Yep. So if you put 6.5, for instance, and the buyer is okay with that, which is the key piece that I would point out, is the buyer needs to understand what that does for them. We talked about the balance of risk because balance of risk is what we do when we write a contract. When you put a number that's higher than what you have as a pre-approval number, you're actually shifting the risk towards the buyer. Because now that buyer might end up in a loan that's a higher interest rate. and they couldn't qualify for the 6% because of whatever weird thing popped up, right? Which we don't have to get into the details of what that might be. There's lots of things that might make that happen. And so now they're at 6.25, but because you put 6.5, they cannot terminate this agreement with the finance contingency because you put 6.5, even though their pre-approval says 6%. So this is a matter of balance of risk. If your buyer is okay with that, that's going to be more attractive to the seller than you putting exactly the same amount as on the pre-approval letter, right? Because that's going to make a difference in their risk, because now it gives your buyer less opportunity to terminate. Okay. Why do you think the rate type matters? Always kind of fixed, adjustable, interest only.
Negative amortization.
The real reason is because just like the percentage and the term and the loan amount, it defines the exact loan that you have to be denied for. Because if you, for instance, mark interest only, and you get a denial letter for a fixed interest rate, those are not the same loan. Even though all the rest of the terms might be the same, might be a 90% loan to value, it might be a 15-year, and it might be 6% or less. But if it's interest only versus fixed, vice versa, that's not a valid denial. Okay, and we'll talk more about that. Obviously, we're jumping ahead a little bit, but that's why that's important, is because this is defining a very specific type of loan. What I love is that they've taken off, and some of you haven't been around long enough to maybe even know, that it used to say what kind of lender, whether it was institutional or, and nobody knew what the hell that meant. So I'm glad they finally took that off, because nobody really paid that much attention to it. All right, so speaking of the lenders, this is one of my favorite parts of the contract. This says use of a particular mortgage lender. So unless an approved mortgage lender is identified below, the buyer may apply for approval of the loans with any institutional mortgage lender licensed to do business in Georgia. If an approved mortgage lender is identified below, the buyer shall apply for approval of the loan with at least one such approved mortgage lender. Nothing herein shall require the buyer to obtain mortgage financing from an approved mortgage lender. So I put XYZ mortgage in under the approved mortgage lenders. My buyer goes out and works with ABC mortgage lender and gets a denial from ABC mortgage lender. We haven't talked about the denial letter yet. We're obviously, all of these things lead towards what the denial letter has to be. And therefore it goes to the point of, is that valid? If they get a loan denial from ABC, but XYZ is the one that's in the box, is that—
Doesn't matter.
What's that, Robin?
Too bad.
Too bad. Doesn't count, right?
It just says they have to apply.
But no, it means that your denial letter, and we'll get to that when we get to it, but you have to have applied with the person listed in this box.
That's what it says.
And later, when we talk about denial, it'll tell you that you have to be denied by the person that's in this box. So what do you think my thought is about putting people in this box?
Don't.
Why would you?
That's the way I feel about it. Don't.
I think you are talk about balance of risk. What happens if that lender just loses their mind and your one contact at that lender like decides to retire to Tahiti and you can't get the denial letter? You're screwed, right?
Yeah, okay, so question, if you put nothing in the approved mortgage lender box, but you provide a lender letter of pre-approval,
Not the same
they
thing.
don't match.
Doesn't matter, it's not the same thing. This does not say that I got a pre-approval from this person. It says that I will apply for a loan from this person.
Well, if you have an approval, apparently you apply.
Not technically,
Oh,
right? Remember, application is one step beyond pre-approval.
all right, pre-approval.
Yeah.
But that's not really part of the contract. if
It's
you just
not.
Provide that.
Correct. Well, it can be if you
yeah, I'm
make
saying
it.
if you send
but
it separate.
If you send it separate, it's not. But remember, this first sentence is the important part. Unless an approved mortgage lender is identified below. So if you don't identify one, the buyer may apply for approval of a loan with any institutional mortgage lender licensed to do business in Georgia. So that gives your buyer the most possible opportunity, which is why I tend to like to leave this blank. Now, as a listing agent, and this is what my point of these contract reviews is, let's look at it from both sides. As a listing agent, if I have a preferred lender that I want you to use, can I ask you to put it in this box? Can I counter on the counter form and say that on exhibit B, conventional loan contingency, paragraph 2, the approved mortgage lender shall read XYZ lenders?
Where would they?
I don't think a seller can require a buyer to use a certain lender.
But this paragraph does not require you to use them. All it
Yeah,
requires
but
you to
but
do
that
is get approval from them.
right.
In the agent's notes where it says you should be approved by Duffy.
So theoretically,
Company.
right, so if you wanted to be Duffy Mortgage Company, which talk about convoluting things. If you wanted to be part of, let's go back to XYZ lenders. And so as a listing agent, you said that the seller prefers that your client get approved by XYZ lenders to prove
Mhm,
their ability to purchase.
mhm.
Because there's so many different lenders out there that, pre-approval doesn't mean anything
Rocket
from,
loan.
right? I
Mhm.
mean, there's so many that, and to be honest, Rocket to me is not one of them because Rocket tends to close deals.
Yeah.
But there are, all these, Rocket being an example, the internet loans, right?
Right.
Like there's so many different people out there that makes that difficult. So that is where you could handle this instead of trying to come up with some weirdo stipulation that puts in the contract, which we used to do back in the day, that said that if you couldn't get approved by your own lender, you would get approved by our lender. And that if your lender fell apart, our lender could close the deal and you would have to buy the house, which was brutal. But theoretically, if you put our lender's name in this box and your buyer's agent is not smart enough to put somebody else's name in this box
Mhm.
also,
Yes.
now you're getting approved by my lender. And if
Mhm.
you can't close with your lender, you're trying to close with mine because the only denial letter that's going to matter is the one from mine. So that's
I think that's
effectively
where
the
I
same
was going with it.
stipulation. And I think that's a wonderful, wonderful thing to do as a listing agent. As a buyer's agent, it's kind of brutal. But again, it's that balance of risk. Because I know that my lender is a functional lender, and if you get approved with them, they're going to close the deal, right? And if they can close the deal, there you go. So these are things that I think you have to think about.
So they can counter, the seller side can counter.
Absolutely. You can counter anything.
Well, yeah.
Now,
Try to.
what you can agree on and what everybody will do is two different things, right? All right, so length of the financing contingency, obviously pretty straightforward. The finance contingency in section 7 below, which I think is weird that they talk about that the day first, but anyway, it's X number of days from the binding agreement date. If you're just going to put in the same number of days as your due diligence, don't bother, right? I mean, it kills me when contracts come in and the due diligence, the finance contingency, and the appraisal contingency are all the same number of days.
You don't like that?
Why? What do you need all these extra paperwork for? If everything's in the due diligence, what do you need all the extra paperwork for? Now, the one thing that's different is that your timelines with these contingencies do extend just a little bit beyond the actual length of the contingency in your time to do things. But I mean, you're talking a few days, like, come on, if you're really putting it that close, you're putting it close, but that's just my opinion. Again, the length of the time, speaking of, length of the time for the buyer to request a reduction in the property, the time period set forth, the buyer to request sales price, a reduction in sales price, if it appraises for less than the purchase price of the property set forth in section 13. Again, I don't know why they're separating these out and not just having it all blended in like they used to, shall be X number of days from the binding agreement date, which is a little complicated. But again, that's an appraisal contingency, right? So it's finance contingency and appraisal contingency, 3 and 4, even though where they talk about those things is further down. Again, I don't really know why that is anymore. And the buyer may apply for different loans. This is where we talk about loan denial letter. So let's make sure we can see this better. A loan denial letter, as that term is defined below, again, here we go, must be for the loans described above. So remember on the first paragraph, we specifically described the term, the LTV, the percentage, and the type of loan. The buyer may also apply for different conventional loans than the loans described above. However, the denial of such other loans shall not be the basis for the buyer to terminate this agreement. Notwithstanding the above, the buyer shall not have a right to apply for a FHA, VA, or USDA loan unless the parties agree to amend this agreement to add a FHA, VA, or USDA loan contingency exhibit meeting the FHA, VA, or USDA requirements, as the case may be. In which case, the conventional loan contingency should no longer be part of the contract. Nothing herein shall require the seller to agree to amend this agreement. Most of you know my recent story of a buyer trying to buy my parents' condo and switching from conventional loan to an FHA and trying to force us to sign an FHA exhibit, and me absolutely saying no. Why? Well, one, that last sentence is why I said no, because we're not required to agree to a different loan. And technically, they didn't even have the right to apply for an FHA loan because they told us they were doing a conventional loan. So the whole bait and switch thing is completely against the contract. But why would I else? We'll talk about, but there's different requirements in FHA, VA, and USDA, right? And so you have to be very careful when you're switching those out that you're aware of the balance of risk of what you're doing, because you are shifting the risk from one party to another in that situation. And we started with the easiest, which was the no finance contingency cash, and now we're at conventional, which is next. And then we go to FHA and VA and USDA because they just get more complicated. All right. Questions about the ability to apply for a different loan?
Yes. Well, no. Can I go back a little bit? Do you hear me?
Sure.
Okay. So going back to 3.3 and 0.4. So let's say the financing contingency is going to be, quick, 14 days.
Okay.
But then let's say that we don't know, when they're actually going to get out there and get it appraised, because those don't generally happen that fast, right?
I mean, 14 days is usually sufficient.
Okay. So
Again,
would you put 14 days, or would you put a longer length of time for, number 4 to be able to change or negotiate a price reduction?
That's actually an excellent question. I'm glad you brought it back up, because my thought process on that varies depending on the situation. If you believe the person to be highly qualified to purchase the property, in other words, we're not worried that they've got some weird job thing, or that they don't have enough income, or their credit score is not enough, or whatever, then your finance contingency period could be very short from the standpoint, or I mean, yeah, it could be, a couple of days, 3 days, whatever, just long enough for them to get through pre-underwriting. And again, depends on the lender that you're working with. Some lenders have programs where you can actually get them pre-underwritten as people, and then all you have to worry about is the property. And so that goes back to, at that point, maybe you don't need a finance contingency at all. Or maybe that lender says, hey, I want a few days. And to Dan's point earlier, Dan said, well, I emailed the lender and asked him, what should I put in for this? Because the lender is the one that has to live up to this, right?
Mhm.
So it is super important that you're having conversation with your buyer's lender when you're filling this out, because if you commit that lender to a 14-day appraisal contingency and you weren't aware that they were having some kind of weird issue on their end where appraisals were taking, 16 and 17 days, you've now just set that lender up for failure and your client.
Mhm.
So my real answer to that is make sure you communicate with the lender. My old answer to that would also be, in theory, you kind of need the appraisal to really make sure that all the financing goes through. So typically, I see due diligence, appraisal, and then finance contingency as far as length of time. So the shortest being due diligence, then appraisal, then financing. So if I wanted a 14 days to get my appraisal in, I might do 17 days for the finance contingency, all things being equal.
Okay.
But, again, you can look at them as completely separate things, because technically the finance contingency does take into account the property, but it also takes into account the person.
Mhm.
The appraisal contingency really only takes into account the property. But what if one of those other issues with the property, like the condo not qualifying, the single family home with the sewer line under it, if those things kept the loan from happening, an appraisal contingency is not going to save you, but a finance contingency would. So safe balance for your, again, balance of risk, minimizing the risk of your buyer would mean that you would have a longer finance contingency than you do an appraisal contingency.
Okay.
Okay.
Yeah, that makes sense. I would have thought, until this conversation, I would have thought about it the other way around. Like, I know that my client's going to get financed, that's not an issue, but the house is iffy. Is it
Right.
going to appraise?
And again, if the appraisal is the only issue, then maybe you're fine with the length of your financing contingency. But what if there's something else wrong with the property? Then your finance contingency is the only way to kind of potentially save you from that. Not necessarily, depends on what it is. There could be issues that would stop the contract in other ways, but just speaking from a finance and appraisal contingency standpoint. Dan?
But if there is a low appraisal, when you get to that section, then there's a period of time for a negotiation,
Correct.
which takes it past.
Takes it past. So
Yeah.
yes, even if you did it's kind of like the 8-day unilateral, right? Like,
We intend to close.
we intend to close, but we could have 8 more days. So, trying to do if you're doing one that's contingent to Josh's point, if you're doing one that's contingent on the buyer's property closing, well, you got to take into account that 8-day unilateral, because what if their property gets extended 8 days? Now all of a sudden you got, so there's just things. This is the fun part of being a real estate agent is balancing all of these things and puzzle pieces
The value.
and putting them together. Okay, this paragraph 6 is one that so many people miss and just don't pick up on. I don't know why. But when it is known, the buyer shall promptly notify the seller of any mortgage lender to whom buyer has sent a notice of intent to proceed with loan application and the name and contact information of the loan originator.
Is that new?
Nope.
I don't remember it.
It's been around for a long time. And it hardly, if ever, gets used. And the reality is that it should always be used. And if they have not proceeded, like, so let's say that the finance contingency has expired and the seller hasn't received notice that they've intended to move forward with a mortgage lender and don't have the contact info for those people. Would you consider the buyer in breach of contract?
Is the word of this paragraph?
Nope, that's it.
Hopefully.
I mean, in theory, if the finance contingency has expired, they better have told somebody they want to move forward with the loan, right? Like, come on. So it definitely brings up a potential issue. I think it'd be a hard fight for a true default, but it's definitely a thing. All right, so now this is where we describe the finance contingency in further detail. So let's look greatly at that. Finance contingency, buyer shall have a finance contingency period equal to the number of days set forth in section 3. Why they couldn't have put just the blank in this paragraph? Do they think we can't read far enough, right? Like, it's just bizarre. Above to, nope, somebody's giving me feedback here. Let's see who's giving feedback. Is everybody? Nope, we're good. All right. Sorry. The buyer has that's the time to determine if you have the ability to obtain the loan as described. Deemed to have ability to obtain the loan unless prior to the end of the financing contingency, the buyer, A, notifies the seller that buyer is terminating the agreement because the buyer has been turned down for the loans, and B, provides the seller with within 7 days from the date of such notice letter of loan denial, a letter of loan denial, geez, I'm having a rough one today, from a mortgage lender based upon the mortgage lender's customary and standard underwriting criteria. The loan denial letter and mortgage lender issuing loan denial letter must meet all of the requirements set forth elsewhere in this exhibit, but may be provided to the seller after the finance contingency period has ended if the above referenced 7-day period to provide the loan denial letter falls outside the financing contingency. Notwithstanding the above, the end of the financing contingency period shall not limit the buyer's rights under the appraisal contingency section of this agreement, provided that the same has not expired. Did you get all that?
So there's two parts. You have to notify the seller before the end of the financing contingency that they've been turned down.
Yes.
And then you have to provide them
A letter.
documentation from the
And this is relatively new. I don't remember when they changed it, but it used to be you had to provide the denial letter with the termination. And so now you have a 7-day grace period to get that loan denial letter, because sometimes these finance contingencies happen on days when lenders aren't doing anything, right? And so that's really the main reason why that is, because if your finance contingency ends on Sunday night, are there mortgage lenders able to provide termination letters on Sunday? Some, but not many, right? So now you can go ahead and terminate the contract and then get the loan denial on Monday or Tuesday and give it to them. Does that make sense?
Yes.
Notice that section didn't talk about the approved lender, but the next section is titled such. So if the buyer has agreed to apply for the loans with an approved mortgage lender, the loan denial letter must be from an approved mortgage lender, which is why, as a listing agent, you want your lender listed as the only lender in that box, if you can get them to do that. If the buyer is not required to apply for loans with an approved lender, then the loan denial can be from any institutional licensed in Georgia, blah, blah, blah. A loan denial letter from a non-institutional lender shall not be the basis for the buyer to terminate this agreement. Careful with that one, because non-institutional is questionable. What does that really, anybody know what that means? Institutional versus non-institutional?
Like a private lender.
Could be a private lender.
Your uncle.
My uncle gonna give you a loan and he says, nope, I'm not giving you a loan anymore. That's not an institutional lender. If you're getting that kind of a loan, I hope you write something different than a conventional finance exhibit. And some brokers fall under the non-institutional mortgage lenders as well. Because they're not actually the lender, they're just brokering. So the broker couldn't give you a denial letter, but the lender that they were putting you with would provide you with the denial. So just a little caveat to that, just to pay attention. These are, I'm going to move this box up because this is very important. Notwithstanding any provision of the contract contained herein, the loan denial letter may not be based solely on one or more of the following: The buyer lacking sufficient funds other than the amount of the loans to close. So in other words, buyer says they're going to do an 80-20 loan. Oh, I don't have enough money to do the 20% down. Sorry, you said you did, because that's what it says when you do the contract, is that you have those funds. Buyer not having leased or sold other real property unless such a contingency is expressly provided for in this agreement. Josh, to your point, that paragraph was added at some point along the line to keep people from using the finance contingency as a contingency of the sale of their property. Buyer not having provided the lenders in a timely fashion with all the information required by the lender, including but not limited to, blah, 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 all the stuff. So if the buyer has been dragging their feet, now, this is a hard one because the lender is going to actually have to step up and say, we didn't get the documents in time. Like they're going to have to say on the denial letter that they didn't get the documents in time. I will say that's rare.
They're not doing that.
They're not doing that.
If they don't
It's
think they're
very
gonna get
rare
the
to see that.
yeah, if they're not getting the loan on this property, they don't want to lose their customer.
Of course. Now, there was a very brief period of time after 2008 and all the mortgage meltdown. There was a brief period of time where we overcompensated, and getting a denial letter from a lender was an act of Congress. It was absolutely impossible to get a loan denial unless they legitimately just didn't. So the old days, back in the old days, you could get a loan denial for anything. Your buyer could say to the lender, hey, I don't like this property anymore. Can you give me a denial letter? Sure. And they'd write up a denial letter. That is no longer the case. It's still tighter than that, but there are lots of things that they can deny for, obviously. The buyer making purchases that adversely affect the buyer's debt to income ratio. I love that this is in here. You should really point these out, by the way, to your buyers. Because if the buyer, we always joke about the buyer that goes out and buys the Ferrari before they get the $1 million house. You need to do it the other way around. Because when you buy that $1 million, that whatever Ferrari or Lamborghini in my case, just because, they're better. You're killing your potential ability to get a loan because you're killing your debt to income ratio. And the problem with that is that you're not allowed to deny or get out of this loan because of that, because of this contract. The property are not appraising for at least the purchase price. So this very clearly states that the appraisal is a separate contingency. So to Lori's point, timing of the appraisal contingency relevant to the finance contingency is important because you want to make sure that if you're going to have an appraisal issue, it happens during the appraisal contingency, not the finance contingency, because the finance contingency doesn't cover that. And the lender not having completed underwriting the loan request. Now, this seems like a very simple little statement, doesn't it?
What does it mean?
What it means is that if you have a slacker lender that you're working with and your buyer gave them everything they needed, they had all the documentation, the appraisal came in, and they just didn't bother to do it. Your buyer's out to earnest money. Now, I think to Josh's point, that lender should do something to make that right, but I have seen many, many, many examples where the lender was like, oh, well, I'm sorry, we just didn't get it done in time. And they push it back on the agent. Say, well, you didn't give us enough time. We gave you 3 weeks. I don't understand why you couldn't get everything done. Every other lender we've ever worked with had plenty of time to do all that. So that's where Dan's approach of getting something, and I would say less in a phone call and more in an email from the lender saying, hey, based on your pre-approval letter, I'd like to put these timelines for the appraisal finance contingency. Are these okay? Can you meet these? Get confirmation. Now it's back on the lender. Again, balance of risk. We have risk too. But if any of these things, the buyer, if they are actually able to use a denial letter, and none of these things apply, then they can terminate the agreement without penalty. get their earnest money back.
And I like lenders who communicate with both agents to say where they are in the process.
Absolutely, absolutely. And it's important as a listing agent to communicate with the lender to make sure that you're staying aware of what's kind of happening. It's not your job to guide that per se, but it is your job to be aware of it. So let's try to keep going and get through this contingency. I knew we weren't going to make the others, but let's try to get through this one at least, and then we can finish the other three in the next session. So the right of the seller to request evidence of the buyer's ability to close. This is an important paragraph also. If the finance contingency ends without the buyer terminating this agreement, the seller shall have the right, but not the obligation, to request that the buyer provide the seller with written evidence of the buyer's financial ability to purchase the property. A copy of a loan commitment from each institutional lender for whom the buyer is seeking mortgage financing to purchase the property, stating the type, amount, terms of the loan, and conditions for funding loan shall be deemed sufficient evidence. The provision of such evidence is not a guarantee of the mortgage loan will be funded or that the buyer will close on the property. Buyer shall have 7 days from the date the seller delivers notice to the buyer requesting such evidence to produce the same. No request of such evidence shall be made by the seller less than 7 days from the closing date. So in other words, you can't request it 2 days before the closing and expect them to give it to you. At that point, it's too late, so it doesn't really matter. Again, we see the seller's right to terminate. If the seller leverages this paragraph properly, they are able to terminate if the buyer is not performing properly. So if the buyer cannot produce after the finance, so this is the buyer can drag the contract out until closing, even with a bunch of contingencies. If they've lost their earnest money, they can just drag the contract out to closing and the seller can't terminate it. Unless they do things like this and ask for, after the finance contingency is ended, ask for evidence of their ability to close. And if that buyer can't produce said evidence, then the seller has the right to terminate. This paragraph is the same as the no financing one from the standpoint of it gives the buyer 3 days to fix that default, and then the seller has 7 days thereafter to terminate. And if they don't, they waive their right to terminate.
So how is the mechanics of the seller requesting the evidence?
You send a notice to the buyer stating that you would like to have written evidence of the buyer's financial ability to purchase.
Signed by the seller.
Signed by the seller. Notice has to be signed by the seller. Okay. Authorization of the buyer to release information to sellers and brokers. This is the same, similar, from the standpoint of that you will talk, everybody has the right to talk to the lenders, basically, right? And I don't think it says anything in here about it changing, but remember at the very beginning, it told you that you were going to tell us with whom you're going to proceed. And then miscellaneous person is the term mortgage loan shall refer to a secured lending transaction where the loan, blah, blah, blah. We know that is what it is. I think that, oh yeah, the appraisal contingency is the last piece. So this appraisal contingency, which is only 2 paragraphs compared to the however many paragraphs the other one was, also could be used other than the fact that it says the lender is going to pick the appraiser. But again, it's the same concept, right? That the contract's contingent on appraisal. If it doesn't appraise, the buyer can submit an amendment to reduce sales price. And the seller has the right to respond to that. And this is a little funny with the timing. Not later than 3 days from the date of amendments to sales price is delivered to the seller, but not later than 2 days prior to closing, accept or reject the ATSP or seek to negotiate with the buyer. So you can just start negotiations within 3 days, right? But here's the key. You gotta be finished with those negotiations within 2 days of the closing, sort of. Not technically, but you should, because you're gonna need time for everybody to finish the loan package and everything. So you shouldn't drag it out right to closing. If it's not been accepted by the buyer or seller, timely delivered to create a legally enforceable amendment, the buyer shall have an additional 3 days, but not later than 1 day prior to closing, to terminate the agreement without penalty. The buyer does not terminate within this time frame, much like the seller's previous, their right to terminate has been waived, and so they will no longer have the right to terminate. So if you're in a 45-day close and your appraisal contingency was 14 days and all of this happens 3 days, by 3 days after that, you're no longer able to terminate because of the appraisal contingency. So it does limit a little bit. And if the buyer does not seek a reduction in the sales price, the buyer shall be obligated to purchase the property for the price agreed to by the parties in the agreement, which is always your right. Back in the day when there were really horrible finance contingency issues, appraisal issues, we had one client who was lost 5 houses because every one of them appraised for at least $100,000 below purchase price. Now, keeping in mind, these were, million plus homes. But every one of them, they were doing a private banker loan and the bank was protecting itself. And so they'd push the appraisal down and that would kill the deal. But it gave them more space, right? And so on the 6th property, when the appraisal came in at 100 grand below, the buyer ponied up an extra 100 grand and just bought the house. So, it is what it is. I think that's the end of that. Yeah. So that's the end of all of those. We have, kind of beaten financing appraisals to death here. But I think that any questions on the no finance contingency or conventional loan at this point? I learned a couple things. And so I think it's important that we take the time to go through these. To that end, next week is sales meeting. So the week after, we will hit back with the FHA, VA, and USDA. I know we don't get to use the USDA very often because we tend not to be able to do USDA in the city, right? I mean, you're not going to farm much. Although, urban farmers is a big movement. But we'll look at it and just kind of take a glance at it. It will be faster to go through those because a lot of the language is similar. But there are some super special caveats that we'll talk about that really shift the balance of risk that we will want to look at. So if there are no more questions, thank you all for coming. I appreciate you taking the time to make yourself better and help your clients have better contracts. And we will see you at the next one 2 weeks from now.
Thank you, Brett.
Have a good one.
Bye.